Good evening, mentorship traders. 8:30 p.m. Wednesday evening, 18th of March 2020. Thank you for logging in. And we are going through some real tough times. And we have repeatedly looked into the markets to figure out how bad can this become. So, like every of our evening sessions, the first few minutes we'll dedicate to what's happening with Nifty, Bank Nifty. Unlike our previous classes when there was not much need to go to the monthly charts, but now the times have changed. And this is the Nifty monthly chart. And a couple of levels which I shared in a recent YouTube video, if you would followed me, was the 7,900, 8,000 level, which is essentially this Fibonacci retracement matching with the November, December 16 lows. And according to me, the worst case scenario for this sell-off is the 2016 lows, which is sub 7,000, which is close to 6,800, 6,900. If I take you to the daily chart, you would have noticed in the last video I mentioned that the 8,555 low of Nifty is something that I don't think will hold and it will get breached, and that's exactly what we saw today. Now, couple of important things that comes. I'm essentially removing these channels which are of no use. Now, a couple of things which are important you should notice here is one, psychologically in terms of the sentiment, 8,555 was an important low psychologically, because that's from where the market finally did see some meaningful rally bounce back, which you can term as a dead cat bounce, because the very next day it opened very weak and sold off for the next 3 days. Now 8,555 is gone today, and of course the sentiment has gone further bitter, especially thanks to the private sector banks which sold off. So it's getting really difficult. It's really getting tough. It's really getting really bad overall. Now, when this kind of a situation happens, divergences shape up. Though you will notice that this kind of a positive classical divergence is fairly wide between these 2 points, but it is very evident that we have a PCD in our hands. Divergences which shape up with panic lows or distress lows are stronger in nature. So the markets probably will try to attempt some kind of a soft landing, if at all. The only difference or the only difficulty to act on this divergence is if you take on the trade bar, your entry point is way ahead, because the high-low range of the market nowadays is very, very wide. So what is the bottom line of this discussion that we just did about Nifty? It's that it's getting distressed, and newer lows are getting made. And with these newer lows, for the first time in this entire sell-off, some degree of divergence have started to shape up. This does not mean that the market has bottomed out. This does not mean that the market will bounce back. It may have bottomed out, it may bottom out, it can bounce back, but this divergence does not mean necessarily. All that it suggests is probably the rate of sell-off will ease off. Probably the index will try to make a range. Probably we'll see some small gains and losses rather than gap downs and gap down. Maybe the series of gap downs should ease now. This is all that I can read from the daily chart. In terms of levels, there's no point looking at the daily chart for levels, because it's always the higher time frames, the weekly and the monthly. And our channel target has been met. The markets have met this channel target and broken further down. And my sense is the sub 8K and the sub 7K mark for the Nifty. In this fall, the way it is falling right now, the weekly chart, which is here, I will do good if I remove these 38, 50, 61. The chart will look much more cleaner. So this is the zone. This is what, yeah, November, December 16 zone. This is where I feel that the index will try to do some kind of a soft landing, maybe, I don't know. The way it's falling, soft landing is a very wrong term, but it's an expectation. Bank Nifty, weekly chart, in this case, if I remove the unnecessary levels and just give it a little more thickness, Bank Nifty is doing a little better than the Nifty in the sense that it is at 61.8 retracement, that's exactly where it is, and it's a little far off. It's close to 18,000 where the December 2016 lows are. The good thing about this level, the 20,800, 20,700 where it is trading right now, is it coincides with the highs of Jan 15. Earlier highs acting as resistances does tend to give us some support. That's the weekly chart, but I seriously doubt whether it will hold or not. Some clarity we'll get from the daily chart if you look at Bank Nifty. And if you turn it into a line chart, the similar kind of a story will start to play out here. These old retracements need to go. Channels also need to go. There you go. So this pretty wide positive divergence has also started to shape up on Bank Nifty. So I get a feeling now that it's kind of rubbing it down on us. Lows from where the index, the market bounced back, is getting brutally broken. Large caps are still selling off. So it's essentially a very depressed and distressed state of the market. And in this kind of a situation, the divergence shape up. And yes, we have such kind of a initial phase of such a divergence shaping up. Too early to decide on anything, but experientially, I would say that it should slow down. Now, probably if we relate this entirety of this sell-off to a lot of extent to the COVID-19 virus, then two graphs you should keep a close watch on is the graph over there, universally how whether it's plateauing out or not, whether it's slowing down. I think a slowdown of that graph, that uptrending graph of COVID-19 cases with the downtrending graph of the indexes worldwide. I think once that tops out, you will see some bottoming out over here also. This is an assumption that majority of this fall is related to that virus. Nevertheless, in terms of levels, we stick to the same thing, sub 8K for the Nifty, and then sub 7K, which is the worst case scenario for me according to the Nifty. I expect that probably next week we should ideally see some ease of maybe. I'm hopeful, because the technical rationale of this expectation is now I see on the larger time frame momentum indicators have started to shape up few divergences. Divergences don't mean a reversal, they mean slowdown of the trend. The trend is down, so I expect that the selling should slow down next week. We will see next Wednesday when we do our session how much it behaves as per our expectation and anticipation. Till then, I would say that trade less, keep it as much intraday as possible, do options if you understand them, and just wait. Like exactly all of us are avoiding a lot of things in our life, work from home, essentially creating a cocoon of yourself so that you are safe. Same thing I think we should adopt for the markets. Just hold, just wait out. This is not the time to do a lot of things. This is the time to not do much. If we don't not do much, probably we'll be better off, safer. And then later when the time comes, we will be able to. All right, so that's our market analysis like always. And now I'll request our mentorship traders to please ask your doubts and questions, and we'll look for trading opportunities